When a highly anticipated movie is coming out
Yeah.
and the studio drops a trailer that just shows absolutely everything.
Oh, yeah, like the massive explosions, the major plot twists.
Exactly. The whole emotional climax is just right there in a 2-minute clip.
Right, and you're sitting there eating your popcorn, and you haven't even bought a ticket to the actual film yet.
But you feel like you've already seen all the best parts. I mean, you are reacting to the promise of the movie, not the actual movie itself.
It's a really fascinating psychological phenomenon. All that hype, all the expected success, it's just completely baked into the public consciousness before the opening credits even roll.
Well, welcome to Market Pulse Daily, your daily deep dive into the forces moving the market. I'm your host, and today we are taking you on a journey into a financial situation that feels, honestly, exactly like that movie trailer.
It really does. It's a perfect analogy for what we're looking at today.
Yeah, so today we're jumping into a deep dive on a clinical stage oncology company called Celis, and we are looking at an August 23rd, 2026 equity research report. We're going to hit the newest price action, the main catalyst, and really figure out what is driving this thing.
Fast, current, and very catalyst-driven. That is the tone for today.
Definitely. But hey, before we get too deep, a quick shout out to our sponsor, StockOracle. If you want to track catalysts like the ones we're talking about today, check the description for a link to a 14-day free trial.
Just a quick heads up, full affiliate disclosure here. We might earn a commission if you use that link. Also, keep in mind that AI insights and value estimates provided by tools can sometimes be wrong, and market data may be delayed.
Right. Definitely always do your own homework. And as a reminder, we don't do buy, hold, or sell ratings here. And this isn't financial advice. We're just looking at the research.
Exactly. We are just unpacking the facts on the ground.
And man, the facts on the ground for Celis outline a massive glaring paradox for you today. Because this company has literally $0 in revenue. None.
Yeah, literally zero. Zero contract revenue for the first half of 2026.
Zero for the first half of 2025, and zero for the entirety of 2023. Yet, despite making no money, their stock has skyrocketed over 778% in the past 52 weeks.
Which is just astronomical.
It is. As of August 21st, it closed at $15.46. That is sitting a hair, just 2.6% below its 52-week high.
Looking at the fundamental realities of this business versus how it is actually being treated on the open market, it reveals this massive disconnect.
Right.
It is an incredible return for a company that isn't actually selling a commercial product yet.
So that brings us to our mission for this deep dive.
Yeah.
What changed? Why does it matter? We are going to figure out exactly why the market is so thoroughly obsessed with this pre-revenue stock right now.
We really need to unpack the catalyst stack. There is a looming make-or-break moment that will ultimately decide this company's fate.
Because going back to our movie trailer analogy, it looks an awful lot like the market is blindly buying into the hype before the actual clinical data, the actual movie is released.
And we need to know if investors are just buying the trailer and, what happens when the projector finally turns on.
Exactly. So let's start with what changed. Because in the world of biotech, buying the trailer can make you a fortune, but it can also leave you holding a worthless ticket.
Yeah, to a canceled premiere.
Yeah.
To understand the stakes here, we first have to look at the mechanics of survival.
Right, the war chest.
Exactly. Before a drug ever reaches a single commercial patient, the company developing it has to survive this brutal, years-long development process. And clinical trials are staggeringly expensive.
You certainly don't run an oncology trial out of your garage. You need serious oxygen.
You really do.
And looking at the SEC filings in our research, Celis has managed to secure a massive oxygen tank. Their cash and cash equivalents reached just over $138.3 million by June 30th, 2026.
Which is a huge shift. That figure represents nearly a 93% increase from where they were sitting at the end of December 2025.
Wow, so they were at what, like 70 million?
About 71.8 million, yeah. They effectively doubled their war chest in just 6 months.
That's crazy.
And the real power of that number becomes clear when you measure it against their burn rate. Because operating cash flow data shows they burned about $16.4 million in the first half of 2026.
Okay, let's unpack this. If they have $138 million in the bank, and they are only burning about $16.4 million every half year, they have a self-funded survival runway of roughly 4 years.
4 years, which, in the clinical stage biotech world, is an eternity.
Management actually calls this out as a significant multi-year runway. They have the breathing room to wait for their data.
They absolutely do.
But I got to push back on how they actually built that war chest, because it wasn't through sales, right?
No, definitely not.
The sources detail that this cash pile was funded by a massive dilution event. The outstanding shares roughly doubled year over year to about 202 million shares.
Right, and that was specifically driven by warrant exercises.
Yeah, so for anyone who hasn't traded these, a warrant is essentially a contract. It gives an investor the right to buy new shares directly from the company at a specific price.
Right, and when investors exercise those warrants, they hand cash to the company, and the company prints brand new shares to give them.
Which means the mechanical result of that is dilution.
Yeah.
The pie gets cut into much smaller slices.
Yeah, which usually makes investors run for the hills.
Yeah.
Because your ownership stake just got cut in half.
Exactly. So why are the analysts in this report viewing this specific heavy dilution as a positive, fortified balance sheet rather than a desperate cash grab?
Because financing risk is the chronic, quiet killer of small biotechs. It is this constant grinding fear that a company will run out of money and just go bankrupt mere months before their breakthrough drug is approved.
Man, that'd be brutal.
It happens all the time. It forces companies to take on toxic debt or sell their assets for pennies. So by leaning into those warrant exercises, Celis made a strategic trade-off.
They accepted the dilution to completely neutralize their near-term financing stress.
Precisely. Shareholders might own a smaller percentage of the overall company, but they now own a piece of a fully capitalized story rather than an underfunded one that might go to zero tomorrow.
Okay, that makes sense. You'd rather own 10% of a watermelon than 50% of a grape.
Exactly. Furthermore, if you look at the balance sheet, it reveals a remarkably clean liability structure. They hold total assets of over $145 million, but total liabilities are sitting at a trivial $7.7 million.
Wow. So that means their liabilities are roughly, what, 5.3% of their assets?
Yep. They aren't drowning in debt while they wait for trial results.
That's huge.
Maximal flexibility is the result here. If they need to strike partnerships or license deals in the future, they get to negotiate from a position of absolute solvency.
Rather than negotiating out of desperation just to keep the lights on.
Right. They have the leverage.
Okay, here's where it gets really interesting, though. Now that we understand they have the capital to keep the lights on for the next 4 years, we need to examine what they're actually spending that $16.4 million a half year on.
This is the core of the catalyst stack. The scientific bet rests on two distinct clinical engines targeting acute myeloid leukemia, or AML.
Let's rank these catalysts. What is the main driver?
The primary engine, the absolute core driver of everything happening with this stock's valuation right now, is their Phase 3 Regal trial. This is testing their drug called GPS in AML patients.
In a Phase 3 trial, that's the final hurdle. It is the most expensive, most rigorous part of the process where you test the drug on a large group of people.
Right, you have to definitively prove it works before asking regulators for approval.
And the entire trajectory of the company relies on this specific trial, right?
Yeah.
Because it's rapidly approaching a highly mechanical, predefined milestone called the 80th event.
Yes. The phrase 80th event is printed all over this research report. It's the ultimate catalyst.
Let's break down how that actually functions, because it's not based on a calendar date. It's not like they just circle a Tuesday in November.
What's fascinating here is the sheer mathematical rigidity of the process. In oncology trials, researchers don't just wait 6 months and see how everyone feels.
Right.
They track events, which usually refer to a patient experiencing a specific clinical outcome, like, unfortunately, a cancer relapse or passing away.
So it's very data-driven.
Extremely. The statistical protocols of the Regal trial mandate that researchers are entirely blind to the data until exactly 80 of these events have occurred across the entire patient population.
The moment that 80th event happens, it triggers what they call a database lock.
Exactly. The data is immediately sealed, no more adjustments, no more patient inputs.
The independent statisticians step in, run the final efficacy analysis, and basically reveal whether GPS actually works better than the current standard of care.
And third-party analysts frame this upcoming readout as a literal make-or-break moment. It will dictate whether the drug becomes a real de-risked registrational asset.
I want to clarify that term for a second. A registrational asset simply means a drug that has gathered enough positive clinical data to be formally submitted to the FDA for registration and approval.
Right.
To get there, they have to survive this lock. It feels exactly like a sudden death overtime goal in a championship hockey game.
Oh, that's a great way to put it.
You have years of laboratory research, hundreds of patients, millions of investor dollars, and it all hinges entirely on this one specific, unavoidable metric. Once the puck drops on that database lock, The game is decided.
You either win the championship or you go home with nothing. That captures the extreme concentration of risk perfectly. It is a massive binary bet.
So what's the financial impact?
Well, if the data is positive, the company's valuation fundamentally shifts overnight. But if it's negative, the core thesis shatters.
That extreme concentration of risk is exactly why Celis is deploying some of their war chest to build a backup engine. Right. Let's talk about catalyst number 2.
Right, which brings us to the phase 2 trial for their second drug, SLS-009. Because you don't want a multi-million-dollar enterprise resting on a single sudden death play if you can afford a backup plan.
So how does SLS-009 fit in?
This trial is targeting newly diagnosed AML. This is a crucial distinction. By targeting newly diagnosed patients, they are going after a different segment of the market than their main drug.
So they're aiming to broaden their potential reach.
Exactly. Now, it is a smaller trial, currently just 28 patients enrolled, but they expect top-line data in the fourth quarter of 2026.
Okay, so a Q4 catalyst.
Yes. This secondary trial acts as a franchise-building leg. It partially diversifies the intense risk of the Regal trial.
So we can look at it two ways. If the Regal trial succeeds, SLS-009 suddenly makes Celis an AML powerhouse with multiple assets targeting different stages of the disease.
And conversely, if the sudden death Regal trial fails, SLS-009 serves as a safety net.
Because they have that 4-year cash runway.
Exactly. A failure in Regal wouldn't necessarily bankrupt them. They would have the capital to pivot their entire operation toward advancing SLS-009. It is an early-stage safety net, but a very necessary one.
Okay, so we've established the confirmed developments, the 4-year cash runway, and we've mapped out the sudden death science of the Regal trial and the SLS-009 safety net.
Right.
But the actual finalized data for that 80th event isn't out yet, which forces us to look at market interpretation, because on August 21st, this stock jumped over 15% in a single day.
The price momentum is just staggering.
It really is. The technical data in the report shows the stock is sitting 150% above its 200-day moving average. It's up over 322% just in the last 6 months alone.
People are pouring gasoline on this fire before the database even locks.
So is this constructive momentum, or are they getting ahead of themselves?
Well, if we connect this to the bigger picture, we have to examine the market psychology driving these technical indicators. And the data is currently flashing some serious warning signs.
What kind of signs?
The stock's relative strength index, or RSI, is sitting at 78.44.
Okay, so mechanically, for those who don't track it daily, the RSI measures the speed and magnitude of recent price changes to evaluate if a stock is overvalued or undervalued.
Right, and anything over 70 is firmly in overbought territory.
The 78 is really pushing it.
Exactly. The buying pressure has been so intense and so rapid that algorithms and momentum traders have pushed the stock way beyond its historical baseline. It is stretched like a rubber band.
Snapback risk is real.
Very real. Another critical metric here is the beta, which is sitting at 2.59.
Let's explain why that number is so dangerous heading into a clinical readout.
You're back.
Because a beta of 1 means a stock moves in perfect sync with the broader market.
Right. So a beta of 2.59 means Celis is hypervolatile. If the broader biotech sector rallies 1%, Celis historically rallies over 2.5%.
But it works in reverse, too.
It absolutely does. If negative news hits, that high beta means algorithmic selling and panic will trigger violently, amplifying the downward crash.
That's terrifying. But despite that risk, there are powerful bullish signals driving this run-up. The research flags multiple whale alerts flashing on August 12th and August 21st.
Yeah, whale alerts meaning massive institutional-sized block trades hitting the market.
When these huge funds buy massive blocks of shares, it forces market makers to buy stock to hedge their own positions.
Which creates a feedback loop that mathematically drives up the RSI even further. Institutional ownership is clearly shifting.
The big money is positioning itself aggressively ahead of the 80th event catalyst.
They are. However, the sentiment analysis concludes that the market is heavily front-running the fundamentals.
Which raises an open question for investors. If they are paying a premium today for a positive trial outcome that hasn't actually been confirmed yet.
Right, they are paying for data that hasn't printed.
Then, if the market has already priced in a massive, overwhelming win before the database even locks, doesn't the potential fall become astronomically worse if the data disappoints even slightly?
Oh, totally. If everyone buys a ticket expecting a masterpiece movie and the film is just, okay, the backlash is brutal.
Exactly.
When a stock is priced for perfection, any deviation is punished heavily. The margin for error is basically gone.
So let's compare the paths here. Bullish path versus the risk. Let's build the blue sky scenario first. If several important catalysts line up positively, how does this company transform?
Keep in mind, the report stresses this is a highly optimistic scenario, not a prediction or a forecast.
Of course.
Step 1 is the most critical. The Regal trial's final analysis meets its pre-specified primary endpoint with a clinically meaningful effect.
The drug definitively works. They win the sudden death game.
Right. Then, step 2, they leverage that massive $138 million cash pile to fund all the expensive regulatory activities. They file with the FDA, they hire a commercialization team.
And they do it all without needing to dilute shareholders with more warrants.
Exactly. Then step 3 brings in the backup engine. The SLS 009 data in Q4 comes back highly supportive, validating their presence in newly diagnosed AML.
They shed the label of being a one-trick pony.
Right. By hitting all those marks, Celis transforms over the next few years from a speculative, pre-revenue biotech into a fully commercial oncology franchise.
Initial product revenues actually begin to flow.
Yes. They strike strategic partnerships that yield milestone payments and royalties. The entire valuation model of the company re-rates.
Because Wall Street is no longer pricing in a high-risk binary gamble, right? They're pricing in recurring economics and a validated scientific pipeline.
It is the ultimate dream of every biotech investor.
But the failure rate in late-stage oncology trials is notoriously high. The science is incredibly difficult. We have to look at the main risk signals, what happens in the bear case.
The primary thesis breaker is brutally simple, and it all rests on that 80th event. The Phase 3 Regal trial fails to meet its endpoint.
The puck misses the net.
The game ends. Because they have zero current revenue, the entire enterprise value rests on GPS becoming a commercial reality. If Regal fails, the core equity case for the stock largely collapses.
And this circles right back to the danger of that 2.59 beta and the overbought RSI.
Right, because the stock is up almost 780% this year, fueled by investors front-running the data. The fall wouldn't be a gentle correction.
It would be a catastrophic cliff.
All those institutional whales who loaded up near the 52-week high would rush for the exits at the exact same time. In a highly volatile stock with a beta that high, the selling pressure would be violent.
Yikes. Also, there's a minor risk mentioned in the report worth noting for full context, right? Celis recently lost an arbitration case to a company called 3D Medicines.
Oh, yeah. The arbitrator dismissed Celis' claims and ordered them to pay roughly $1 million in legal fees.
Which, while nobody likes losing $1 million, in the context of a $138 million cash pile, that's a contained nuisance.
Yeah, it's a mild cash burn, not a fundamental thesis breaker. The real existential risk remains purely clinical.
This raises an important question regarding the psychology of investing in this space. How much unquantifiable risk are investors truly taking on when a stock's valuation is completely detached from current revenue and anchored entirely to a single locked database?
Right, because we can analyze the balance sheet, we can track the institutional whale alerts, we can measure the RSI and the beta until we're blue in the face.
But none of that financial engineering actually tells us what is happening inside the biology of those 80 patients in the trial. The science is entirely blind to the stock price.
It is. Human biology does not care about a 200-day moving average. It doesn't care about whale alerts.
That fundamental disconnect is the terrifying thrill of clinical stage biotech investing. You are placing a financial wager on a biological unknown.
So to bring this all together and summarize the landscape here, Celis is sitting in a fascinating, highly precarious position. On one side of the ledger, they are a fully capitalized operation.
They took the pain of heavy dilution, doubled their share count via warrants. But in exchange, they built a formidable $138 million war chest.
And with their remarkably stable burn rate, they have secured a comfortable 4-year runway. They have the oxygen to survive.
But on the other side of the ledger, all of that financial stability is just a well-funded waiting room. They are holding their breath for one extreme make-or-break scientific moment.
Exactly.
So for you, listening to this deep dive, what are the top 3 things to watch next?
Okay. The singular most important development, the next event to monitor over the coming weeks, is the official corporate announcement from Celis that the Phase 3 Regal trial has hit its 80th event and locked the database.
That is the ultimate catalyst.
It is. The second thing to watch is the confirmation signal, which is the final efficacy analysis itself that follows the lock.
And the third thing?
The main risk signal. Any delay in that 80th event timeline, or obviously a negative readout. Every other element of this investment thesis, the Q4 backup data from SLS 009, the cash runway, the technical momentum is entirely downstream of that one statistical reveal.
It all funnels down to the 80th event. We really want to thank you for coming along on this deep dive with us today on Market Pulse Daily. Digging into the actual mechanisms behind a near 800% run-up, understanding the difference between warrant dilution and clinical endpoints, is really the only way to truly decode what is happening under the hood of these massive market moves.
It is entirely about separating the financial momentum from the biological reality.
Absolutely. Before we go, a quick reminder to check out the description for that 14-day StockOracle free trial link. Full affiliate disclosure, again, we might earn a commission if you sign up. And remember that AI insights can be wrong.
And data might be delayed.
I want to leave you with a final lingering thought to ponder as you go about your day. We've talked extensively about the extreme binary nature of this specific biotech investment. Years of research, hundreds of millions of dollars, the hopes of patients. It all funnels down to a single 80th event in a human trial.
It's sudden death over time.
But as artificial intelligence and predictive biological modeling become exponentially more powerful over the next decade, we have to wonder, will this kind of all-or-nothing human trial suspense eventually become a relic of the past? Will computers soon be able to flawlessly simulate that 80th event before a single pill is ever swallowed? Or is the chaotic, beautifully complex unknown of human biology always going to force the market into these massive high-stakes gambles?
That's a great question.
Because right now, the market is just sitting in the theater watching the trailer and waiting for the projector to turn on. We'll see you tomorrow.